Welcome back. It's time to check in with Philip Petursson. Philip Petursson is Chief Investment Strategist at IG Wealth Management. As you can see, he's in our studio right now. Good morning. Thanks for coming in.
Thanks for having me.
I'd love to get your thoughts on the price of oil. It's very much a focus of investors. Obviously, the conflict between Israel and Iran is the motivating factor right now, and investors are very concerned, as they are when conflict breaks out in this part of the world, about the flow of the commodity out of that region.
And there's a couple things you have to consider. One is the economic backdrop of higher oil prices, where higher oil prices are a tax on the consumption of oil and oil-based products. So it can be a headwind for economic growth as we go forward. But then on the other side, there's the investment opportunity. And as you get conflicts like this in the Middle East, it does drive the price of oil higher. That's good for the Canadian oil producers. That's good for oil producers in general. And I think this can stick around a little bit. We started to see some upward pressure on oil ahead of this. This was a catalyst to kick it above $70. I think we could remain at these levels, which is good for oil, good for the TSX.
Interesting. There is news actually from the Strait of Hormuz. It's not related directly to the conflict. According to experts, two giant ocean-going tankers collided and caught fire near the Strait of Hormuz. This is being reported by Bloomberg News. That is rattling global oil markets and shipping markets. But people involved, I guess, with the companies who own the tankers are saying the situation was, quote, navigational and, quote, unrelated to the current regional conflict. So there you go. There's always something possible in that part of the world. And right now, one thing the market is looking at is a collision between two ocean-going tankers that has resulted in a fire near the Strait of Hormuz. What's your view more broadly on geopolitical conflicts and the price of a commodity, chiefly oil?
Right. And so this was the uncertainty coming into it. What would Israel do? And this is something that we had talked about a few months ago as well, that there was a threat of Israel bombing Iran because of Iran's support for Hezbollah and Hamas. Well, that came to fruition in this past week. And on the one hand, while geopolitical risk kind of raises the tension out there, on the other hand, knowing that, okay, we've hit that marker, we know where we are today, we can remove that uncertainty in a way, and it actually brings a little bit more certainty into the marketplace. As odd as it might seem, it can bring some confidence back into the question of where oil prices could be headed.
Okay. You are becoming more bullish. You told me just before we came on camera, more bullish on markets more broadly. That's interesting. Why so?
Yeah. Coming into the year, there was a number of uncertainties that existed, the tariffs being the key one. And I think as we continue to move along, you're starting to see the removal of these uncertain elements in the marketplace. Iran and Israel being one, tariffs being another one. Now, we're not done with tariffs just yet, but we know at what point Trump will not cross. We saw that on April 9th when the bond markets were saying that's enough, and Bissett most likely was whispering in his ear and saying, okay, it's time to back down. And he's done that. And so even though we're stepping into July and the 90-day pause perhaps coming to an end, we think that the worst for the tariffs and the worst of the geopolitical uncertainty is behind us, not in front of us.
What do you make of the speed of the rally and the magnitude of the rally that we've seen since early April? I mean, it has been very dramatic.
It has, and it's been a surprise. I would say we didn't expect the rally to be this sharp, this fast. I mean, we were positioning for it, and we were able to take advantage of it, but we were thinking and perhaps hoping a little bit that would have dragged on a little bit longer through the summertime for what would be normally a traditional like fall rally. But we didn't get that. That's fine. As I said, we were able to take advantage of that. I think it's this buy the dip mentality that has entrenched itself into retail investors. That anytime the market is down, remember, we were down 22% intraday top to bottom. I think that was a signal for retail investors to say buy. And they've been conditioned to do so, and we're seeing the aftermath of those.
So speaking of U.S. stocks right now, you're not concerned about where valuations are you, on the S&P 500 right now?
Valuations have been improving. As earnings growth has been coming in, valuation, with the stock market even staying where it is from the start of the year or near the start of the year, valuation has been coming down. When you look at valuation across the index, it's also been improving. So it's not being pushed higher by just a handful of stocks. You've got a number of stocks, better breadth in the market, better valuation across the market. So if you're active, if you can pick your spots, and in fact, the Mag 7 have not been the place to be for most of this year, then you've actually done quite well. And valuation, I don't think, is as much of a concern going forward, even still with perhaps a little bit more of a modest earnings backdrop through the back half of the year. But I think valuation is in line with where a reasonable expectation for it.
Isn't the earnings backdrop or the earnings outlook a bit clouded? We didn't get a whole lot of guidance from companies in the most recent reporting season.
Very true, and that's because they didn't know where tariffs were going to stand. But there are a couple other factors that will help drive earnings up through the remainder of the year, and that has been the weakness of the U.S. dollar. As the U.S. dollar has weakened, all those foreign earnings are boosted in terms of currency translation. So the S&P 500 earnings probably won't see as much of a hit as we had expected with the full brunt of tariffs early April.
Canadian stocks, what do you think? Can this outperformance last?
I think so. TSX continues to hit new highs on coming from areas other than oil, although we're getting oil participating now. So think of the three big sectors on the TSX. You have energy. I think we've got some positive catalysts there going forward. You have mining. Gold is still going to be a driver of that. And then you have the financials. As the yield curve continues to steepen out, that's good for banks. I think the Canadian economy is doing a little bit better than anticipated, and so that's good for the overall economic backdrop and good for the backdrop of the banks going forward.